in the show right now. Anurag, hi, morning. Good to have you on the show. Anurag, domestically, of course, as everyone's waiting out for the GST rationalization, what the slabs and the math is going to be like. But it seems like it's a status quo right now when it comes to tariffs. Since day before, we're living in that 50% plus regime. How is it that investors, you think, should balance both these cues?
Yeah. Aisha, morning. So I think markets don't have to worry about the 50% tariff so much because the cell phones are still exempted and pharma companies are still exempted. So it's largely small players within, the garments, textiles, footwear, and some of the gems and jewelry. That's not much of the market capitalization which is under question, right? So I think the message from the government is that, just try and move on from here. That's the call government has taken. They have protected everything else. And this is a small cost in that sense. I mean, it's a cost, but it's a small cost to protect everything else within the economy. And services continues to export well to US. That's not under threat. That's India's major strength. So I guess I would just move on from here. I think we should just until the government really gives a strong signal, I would just move on from this point. It's a non-issue. It's not being discussed in US. I think we should also in Indian markets also, we should move on from here and not make a big fuss about it for now, because it is what it is.
Oh, absolutely. It is what it is. So, Anurag, what should investors be doing right now? Do you think a larger allocation to consumption perhaps is the par for course, the need of the hour right now? Wean off a little bit from capex. Is that how one should look at portfolios in the days to come?
So, Aisha, I think I am of the opinion that markets are very richly valued for past 2-3 years. And, we have been talking about it. By the way, last time we ended on a bearish note. We are not bearish. Markets are, we are bullish or bearish on markets. So I'm very bullish, but on different markets. But currently Indian markets, I think we should be at best be neutral. Past 1 year has been pretty much flat. So regardless of the Pied Pipers and the bullish pharma bulls, the market for the last 1 year, Nifty 50 or Nifty 500, has gone nowhere, right? And basically that's how it's going to be probably for another 1 year, right? So with that sense, I think it's nothing different but averaging of the super normal 20 to 30% returns from 2021 to 24, and then averaging for a couple of years so that eventually the average becomes about 12%. I would just stick to sectors which are not the flavor of the last 2 years. So I would avoid those, which is basically your defense, exotic, EMS and all those fancy electronics, solar, all those companies. And I would I think you are right, probably be more safe within consumption, which is more domestic oriented. Plus, I think, again, those safe financials, private banks and some of these companies are fine. Healthcare is always good for me, regardless of what we do. It will always be a scarce commodity in India. So that's how I would be largely placed, but very, very defensive. And I won't mind putting a significant, if your money is tied up in India, good 30% of it can also be in bonds for now, bonds or fixed deposits or some such thing, not too overweight on equity.
All right, not too overweight on equities, but yes, Anurag, we have been talking about the higher valuations for quite some time now. But Anurag, to the point that you were making, that services export continues to be quite robust, and that was one of those areas wherein uncertainty around the US discretionary spend, what AI will do to the Indian IT companies, that was the major concern. But given the kind of underperformance IT pack has shown, do you believe there stands a chance wherein one can start looking in IT, or do you believe that the growth will be way slower versus the economy growth?
Yeah. So, Rishi, if you go before 2020, these companies were enjoying multiples of 15 to 18 to 20, correct? All below 20. And now almost everything is about 25, 30. I'm talking of the large cap companies. So even though the companies might protect their margins by hiring lesser and leveraging AI, ultimately the multiples need to come down. You can't pay 30 times multiple for a company which is growing at 4%, right? You can do it for a while. How long can you do it? So I'm reasonably sure that there's not a very strong runway for next 3-4 years until these companies figure out how to survive in the AI world, because they are being disrupted. They're not the disruptors. They are actually being disrupted. So they might survive, but you need to give lower multiples. Mid cap, I don't want to comment. I mean, those are pretty small companies. I don't understand some of these companies, barely 1 billion in sales and whatnot valuations we kind of accord them. That's kind of beyond me, but then that's because I have other options. I'm not tied up only within the Indian market. That's about 15% of my portfolio and even lesser these days. So yeah, that's my quick take, Srishti, on IT. Yes, we should be very cautious on IT as well.
Okay, cautious in IT right now, add a little bit more to consumption. But Anurag, even when you look at the consumption pool, right, there too valuations are frothy. Given that it's a large umbrella, I think the debate is more about whether you go and tilt towards premiumization, or do you look at staples which have been completely underloved and underowned for quite some time now?
Aisha, I think it's beyond conclusion now that the debate in India is only premiumization versus the mass market. Premiumization is the only place to be. Basically, the buying power in India is in the top 10% of the population, and that keeps rising up regardless of what the rest 90% does. So I would always lean towards premiumization in almost everything that we are trying to do, right? Be it consumption, real estate, all the consumables, all the ancillaries, everything, autos, everything lean towards premiumization, because that's where the real market is. That's where the real consumption is. Now, in terms of overall allocation, well, I'm saying if you're a compulsive buyer and you have to stay in the market, that's where you can park your money, because if the market corrects, those sectors don't correct as much. No doubt they're pretty expensive, right? But it's only if you can't get out of the market. But if you can, well, I mean, feel free to do so, because, I mean, in this market, even if you go 50-50, you're not losing too much. 50-50 in the sense that, you've got 55% in equities and rest, probably a combination of debt and cash. Because understand, at least debt has given you 8% for the last 1 year. Equity is pretty much flat or down, right? So if that happens for 2-3 years more, you are better off there as well, right? So it's hard to say how, everything depends on the flows. As long as the flow will continue, markets will not correct, but they're not running away in a hurry. So that's the limited take, Aisha.
Right, absolutely. Okay, Anurag, great having you on the show. Thanks for your time as always.
Thank you.
Okay, let's move on and let's talk about what the domestic cues are going to be looking like. You've got the Reliance AGM today, a potential